Jani, Head Mutual Funds, Anand Rathi Wealth joining us, and we also have Sanjay Shah, Chairman, Managing Director, Prudent Corporate Advisory Services, to talk to us about, of course, all that's playing out with regard to the AMFI numbers that have come through, and whether those numbers are actually sustainable, how are trends playing out on ground. Shweta, let me come to you first with regard to how those numbers are. Talk to us first off about how you saw the numbers. Was it a positive surprise for you? Or did you expect the underlying momentum to sustain?
Hello, good morning.
Good morning.
First up, in terms of the overall numbers, if I have to see, it wasn't too much of a surprise on the net flows. For equity, they've been at around 29,000 crores, for the last few months. A slight dip in those numbers compared to the previous month wasn't as surprising, but the surprise element was your SIPs touching 31,000 crores. Ideally, I would have expected your October numbers for SIP was somewhere around 29,500. We saw a marginal dip in November with, for the SIP numbers. So December, ideally, we would have expected a 30,000 or 30,500 crores kind of an SIP number. So 31,000 coming in is, I would say, a positive surprise. Even on the debt side, it was December, the quarter end, and that's the time where you see outflows coming in from liquid and money market instruments. So debt again wasn't pretty much a surprise element, but yes, SIP flows shows in that the retail interest is very much there. The discipline, not being bothered about the volatility in the investor behavior, is kind of showing up here.
Right, makes sense. Sanjay, I want to get you in as well here. It's been a rough one, start to the year for the markets. Do you suspect that these kind of flows could be challenged at some point, or do you sense that DIIs will continue to have conviction in SIPs?
Hi, good morning. And I think I can tell you frankly, if you look at last 12, 18 months, market has definitely been going through a tough patch. And if you look at the returns of small and mid cap category, because the headline numbers are looking reasonably good because of the large cap outperformance, but the mid and small cap has not been doing that great. In spite of that situation, I think the retail has continued to remain confident on the long-term story. And probably for the first time, we are also seeing on the ground that genuinely behaviors of the investors are changing. So if you look at even I also believe that crossing 31,000 crore has been definitely a very, very strong fillers. And if you look at within the 31,000 crore of SIP book, or even the new money or the net flows of also 42,000 crore, the large portion is now probably going into a multi-asset allocation as far as new allocation is concerned. And the new money is not going thick and very largely into the mid and small cap. So the hybrid, your large cap, and the multi-asset allocation is getting a lot of traction, which is also a very good sign, because multi-asset allocation as a category will give you a lot of stability and lower volatility as far as return is concerned. So you can say that retails are now coming of an age, and I don't see a huge change in the sentiment. I think it's a very positive sentiment on the ground.
Okay. Is you seem to allude to the fact that there is a change in behavior, Sanjay. But we've seen that in every bull market, right? And while we aren't smack in the middle of one, but this has been a bull market of sorts. Do you believe that there is a concern with regard to a possible change with regard to behavior, if at all, something were to likely go wrong with regard to equity markets? Or do you believe very, very strongly that the behavior change is very real on ground?
To be very frank, I think we have not seen the worst of the time, because the serious drawdown, persistently of a long-term nature has not came. So it's very difficult to conclude that the behavior has changed for a long period of time, and people will not go into a fear mode when the persistent drawdown comes. So if you see that this kind of market volatility continues for 3-4 months, then probably we need to definitely look at. But still, my belief is that it's not going, because our expectation of people are not very huge. When people used to come 20-25% kind of expectation. That is not the situation. Plus, you do not have a very large alternative options available for you to invest. So still, you might see some kind of tepid momentum, some kind of change in the mood, but saying that there will be a huge reduction in the SIP book, which will go down from 31,000 crore to, let's say, about another 5-6,000 crore of closer, that situation I don't see. You might see that because of the lull period, new money might probably come into some consolidation phase. Few thousand crore here and there can happen, but largely significant change in the sentiment should not happen.
Okay. Shweta, let me come to you with regard to the same question. What are you seeing on ground? Do you believe that some of these flows seem to be sustainable? And is there at all a concern with regard to the possibility that if the markets were to turn a corner, these flows could also see sharp withdrawals or sharp pullbacks, if I can call it, not withdrawals. I restate that.
Honestly, I think there is a change in the investor behavior where the maturity is definitely improving, and investors today have gone through that phase where they've seen what happened in COVID, where there was a 37-38% fall from the peak, but markets rebounded within few months. And also, like Sanjay was mentioning, if you look at the alternatives, what is the alternative? You have debt, which is at 6.5% against that. If you stay invested for long-term, equity has the potential to give you double of what debt is giving you. So that is where I would say this investor behavior or the maturity that we are seeing, that you have to stick through in equity for longer time periods, would continue. In fact, I would say there are three elements today. What's also changed as compared to 5 years back is there is accessibility to equity, affordability, because you have SIPs which are available to you at 100-250 rupees a month in the form of micro SIP, as well as awareness of how you can participate in equity through mutual funds. So all these factors would also mean that you would see a steady pace of growth in the equity assets that we are seeing. Yes, we could see more money coming in the form of an SIP as compared to lump sum, because a disciplined way is the approach I think people are following now. They think it's better to just stagger your investments and participate in equity rather than putting it in lump sum. So that's a slight change, one could say. But I don't think that if there is a 10-15% kind of a correction in the equity markets that come in, we could see the flows coming at a halt or seeing a drastic reduction. That's unlikely.
Shweta, also, the kind of swift churn that one is seeing in the market in terms of a rotational shift, I want you to add some color in terms of where exactly sectorally are you seeing flows move in? Because sectoral funds as well have done, quite good in the previous year.
Absolutely. Sectoral funds in pockets have done well, and every year you will have that cyclicality playing out where you'll have 1 year banking doing well, 1 year defense doing well. And now it's not only about sectoral funds, but it is also about those factor funds which are coming in. You have momentum, volatility based funds which are available in the market, which was not there 3 years back, where, there's more there is more options available for a person who understands equity market to play out their investments. But one thing that I'm also seeing is not many investors are aware about or have the sectoral knowledge or the timing knowledge of when to enter and exit. So which is where incrementally I think we would see money is moving more into diversified categories as compared to money is flowing in sectors. But of course, a few of the sectors where we could see money coming in, given that there's a lot of geopolitical issues, we could see defense coming up as a sector where we see money flows. Banking and financial services, I think, is more within those sectors where you could see a lesser volatility, so money is going in there, plus the way we're seeing the credit growth and all. So you could see some of those themes getting in more money. Consumption, we've already seen from almost September, October onwards, some sentiment build up coming in consumption. If numbers play out in terms of earnings, we could see some more money flowing in over there. And I think infra again depends on budget. What is the kind of government allocation towards capital expenditure, and that again is a sector where we could see a rebound sentimental impact coming in. So that's my understanding.
Sanjay, quick question for you as well. Give us a sense, there's going to be policy changes on the anvil. How much of that is going to hurt, as always is the case, yields? If I don't ask you that question, it's not the interview is not over. So I'm trying to get a sense as to how this hurts the industry, how this flows through the industry, who absorbs it, and how does it change yields across the industry? Give us a sense.
Yeah, so that change is going to happen after the entire circular which came from SEBI from 1st of April. Still, it's little bit premature for me to talk because my belief is that by end of March, I think there will be a lot of discussion which will be there with the AMC because as you are very, very rightly saying, there are two changes which has happened. One is the GST is now allowed to be charged by the distributors and the overall, I think the government has reduced about 10 basis point because of that. What is going to be the actual cost of that? Some AMC might have the impact of about 7-8 basis points. So there might be a 1 or 2 basis point pain which has to be bear by somebody, and the larger portion would be a 5 basis point exit load. So it's very difficult for me to say. We will wish that this time the pressure is not transferred to the distributors because I think on ground distributors are also now gradually because of the economies of scale, the yield is under the pressure. So, but very, very premature for me to comment anything on that as of now.
Right. Okay, both of you, great to have you today on the show. Thanks for all that insight. And here's fingers crossed. Hope SIP flows remain intact, even if the markets show the volatility. I mean, the typical nature as it may be, you need to just stay put and ride the course. And yeah, it's the power of compounding which always plays out with SIPs, doesn't it? But let's